In this video, how to implement a trailing stop order when trading crypto. Also works for Forex and equities. It's all the same. We'll look at how exactly to implement a trailing stop on a trading system right here, and then some of the things to think about on where to place a trailing stop loss and when to place it as well. All of the timestamps for that down in the description below. Not every crypto trading system gives you access to trailing stop orders. Here are some of the biggest that either do or don't give access. I'll leave links to these exchanges down in the description. You can get thousands of dollars worth of deposit and trading bonuses via those links. So check out the details down in the description. When we want to implement a trailing stop order, we need to give the system exact details. And so we need to know what it's actually asking for right here in terms of ratios and variance and quantity. On a crypto trading platform, come up to the top of the order screen. If you're trading futures, I'm going to show you, and then you can choose a trailing stop. If you're using something like Binance, it's exactly the same trailing stop order up here, as you can see. And on other platforms such as Bitget, it's right here, trailing stop. So you can choose that. Now, depending on the platform, it might be called a little bit different. So let's go through what the fundamentals are. We have really two different parts of the stop order that we need to implement. The first is the trigger price, as it's usually called. This is the price at which you want the stop order to actually be executed. So remember, with a stop order, nothing happens with any order until the trigger price is met. Only when the trigger price is met, then does all of the other parts of the order actually start to execute, if they can or not. And we can choose all of those details. So that trigger price is the price at which the trailing stop order is executed at. Now, the other big part of a trailing stop order is the callback rate. This may be known as variance or delta on certain platforms, but it's basically the difference between where the order is triggered and then where the trailing stop actually is, right? So if you want a sell order at 2% below the trigger price, that will be a 2% callback. 3%, 4%. It may also be just written in dollars. So you may have a dollar amount between that trigger price, right? So the trigger price is something where the order actually starts to execute at, and the callback rate is, well, how far away do you want this trailing order to be? What exactly is a trailing stop then? Well, it's an order that follows upwards at a certain percentage, but then stays there if the price moves down. And this would be known as a trailing stop loss or a trailing stop sell. You may actually be just locking in a profit here, so you wouldn't be taking a loss. But what you're trying to do is essentially have a sell order at, let's say, 5% below the current price. And if the price, you can see this delta right here, right? The difference between them. And then as the price moves up, the stop order also follows it upwards at that 5% threshold. So it never goes, closer than 5%, because that's what we set it out on this occasion. As the price comes down, you can see though, the trailing stop doesn't come down. It just stays where it is. So as the price moves down, it just stays where it is. And then as the price moves up again, you get the trailing stop following it up at that 5% threshold. And then as we come back down, if the price comes down far enough and actually hits our trigger price, that's when we sell out. This is for a long order when we have a long position and we're looking to essentially follow the price up and basically take profits at some point as the price falls back down. So a trailing stop would be a sell in this case. It's sometimes known as a trailing stop loss, but also just a trailing stop because you might be locking in profits. Come to your trading system then and choose either the ratio or the variance. MEXC gives us both of these options. If we choose variance, we choose an actual amount of dollars that we are below the current price when we enter that order, or we can choose ratio and then we have a percent right here. So let's say 5%. So now if we enter this order, our trailing will be about 5% from that price, assuming we're in a long position and we're looking to sell out and lock in profits. Then you can just choose the amount on the quantity. Now, if you're in a long position and you have $10,000 open, then you may want to close that same amount, right? You can also choose the amount of the crypto that you're trading. So if you know that you're in an open position for one Bitcoin and you're looking to close that out and lock in profits on the way up, then you can obviously out for one BTC, whatever that may be, right? So you can choose that as you want. So on MEXC, we'll do an amount right here. Now, as you can see, there's an activation price as well. we'll know that as the trigger price right here. So the trigger price is a price that we want that order to actually trigger at. Now, if you're looking to short or actually kind of get out of a position, so you're in a long position and you want to close that off, so you're looking to trail the price up and then take profits and lock in profits there, that trigger price or activation price. Now on MEXC, you don't have to have an activation price. If you leave it blank, what's going to happen is it will essentially open this order at the current price. So the current price is around this, as you can see right here. So if you're in a long position, you can just say open short. So if you've got one BTC long, you can now just press open short right here for one BTC. Now you'll be opening at this price and your variance will be 5% underneath. As the price moves up, you'll keep it there. And if the price comes back down, it will just stay there until 5% downwards has been achieved, and then obviously you'll sell out at that price. But you can also put an activation price above the current price. So let's say our activation price is 30,000. What that would mean is this trailing stop order is not going to even be in the system until we reach this 30,000 threshold, currently at 23. So let's open a short. And as you can see, we're right here. We have a BTC USDT position here to go short, and the amount right here in the total variance. Now, as you can see, we are not open on this order yet because our activation price is much higher. And so what would happen here is that the price at 30K, that would open our 5% variance position and our stop loss. And so it's as simple as that, where you can actually set a price and then either long or short. Now, in this case, if you're taking profits to the upside, you want to obviously be opening a short position there with the futures because you have a long position already. When trading crypto, we can also implement trailing stops to the downside as well. So if we're trading long, we can implement that trailing stop to either have a 5% loss or either lock in profits if the price moves up. With a trailing stop, if you are selling short in the futures market, that is, trading futures and taking a short position, so you're trying to benefit from the price going down, then obviously you might want to implement a trailing stop if the price rises to make sure that you don't lose more than a certain percent, and the actual trading stop can follow the price down to lock in profits as well. So it's the exact flip side of a trailing stop on a long position. So here is the activation price at some point, and your trailing stop, let's say it's 5% away. As the price moves down, you follow the price down. As the price moves back up, you just move sideways. Now, this is for a short position very good because you have, let's say, a 5% max potential loss because you implement your trailing stop. But as the price moves down, you're trying to lock in profits. So it's the exact opposite what we would do if we had a short position right in Bitcoin here. We would look at a trading variance of, let's say, 5%. We would choose the amount that we're long in. So if we've got one BTC, we would want to trade out exactly one BTC out. And obviously the activation price, you can set that at a lower price, but you don't need to. If you just keep this off, it will trade at the prevailing market price. And then of course you would open a long position there. Now that long position would be 5% now above this, right, to close off. So whatever your opening price is, your activation price, or if you just leave it blank, that would be the market price. Your buy order to stop out your short position would be 5% above this mid price here, and it would constantly follow down. And then if the price does move back up, you would basically be locking in profits as long as the price moves down, at least to your in profit level. How far away should we set the callback or the delta? There's a few ways to work this out. One of the most simple is just to look at the daily volatility of the asset that you're trading. So an easy way to do this is by using ATR. If you go to a trading system, go over to the indicators, just click this and then search for ATR or average true range. That's going to give us an idea of the maximum potential one-day move in the asset that we're trading. ATR, average true range, it's just an average of the true range of the asset within a day. And so that's going to give us a good idea of how much this asset actually moves on a normal basis. So as for ATR right here, this is the ATR for Bitcoin right now, trading at around $700. So that's a dollar figure. So just take 700, divide it by the current Bitcoin price, which is let's call it 23,300, you're looking at around 3%. So for right now, a 3% daily move in Bitcoin is actually normal. So when setting your total variance, you might want to give yourself a little bit more breathing room because 3% is a normal move anyway. It really depends on where your position is. If your position is in great amounts of profit already, let's say you traded this and you're just in great profits and you are really done with the trade, like you think I'm kind of done and I think the trade has run its course and I'm kind of okay to get out right here, right now, then what you can do, instead of actually getting out and saying, I'm just going to I'm going to close the trade, you can actually have a sell order or a trailing stop order to sell out at a much closer tick, let's say 2% or 3%. And then what you're saying is, I'm happy to take my profits and I've made more than 3% profit. If it goes down 3%, then I'll know I'm happy and I'm out of that order. Or, maybe the price kind of goes on a bit of a run again, and then that's basically free profits from that trade. So a trailing stop is really a good way to kind of end an order that you've already made profits in, to say, I'm happy to take the profits even with 3% potential downside from the current price, but if it does run on in my favor, then that's good as well. So that's a good way to use a trading stop loss to actually just get an order finished, but potential like having a call option basically to the upside if it does run. Check out the Crypto Investor course for 300 more videos like this down in the description. Deposit bonus is down there as well. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.